Hello, everybody. Welcome back to another episode of Season 2 of the Loan Officer's Playbook Podcast. Today, I'm joined with Daryle Messina. Daryle has been a VP at multiple mortgage banks and has over 30 years of experience in the mortgage industry and is one of the best disruptors I know in the industry. Welcome, Daryle.
Thanks, Michael. Appreciate you. Thank you for having me.
Amazing. Daryle, we've known each other for a while now, and
Yeah.
I just really love the way you think about the industry. I love that you're forward thinking. I love that you're starting something new. And I just want to ask, let's get right into it. What are some of the trends that you're seeing in the industry right now?
Yeah, there's a lot of different trends. I think if you talk about like pre-pandemic, people are moving every 7 to 8 years, right? I mean, that was pretty much the typical trend you'd see. Today, people are staying in their homes longer. It's close to like 13 years. So that's a trend that's really not favorable if you're in the mortgage space. We like people moving, but the rates were so historically low during the pandemic. Unless you were asleep at the wheel, you're sitting on a house with an interest rate in the twos, threes, maybe fours. So I just think that's really, I think, created a lot of stagnation in the marketplace, right? There's not a lot of people moving, so not a lot of mobility. That'll probably change, right? Couple of the other bigger trends I'm seeing is just you go back to the peak of 2021, there's 400,000 loan officers in the mortgage industry. You look at the number of loan officers that renewed and decided to sign up for 2025, it's down to about 270,000 to 300,000. So that's quite a big shakeup, So certainly seeing some thinning out in the mortgage space for sure.
Yeah. I mean, let's talk about that for a second. That's more than a 50% drop in workforce. Like, how do you see that affecting the industry going forward?
Yeah, I mean, you're going to have to figure out a way to be more efficient, right? I mean, at the end of the day, I think people are going to have to be willing to work for less, and you're going to have to do more transactions to earn the same amount of money you were maybe making, 3, 4 years ago. You're going to have to do 3, 4x the number of loans you're accustomed to doing to remain relevant in the business. I mean, that's just, I think, the trend that you're gonna continue to see in the business. Yeah.
Yeah. I saw a stat from what you just mentioned from there's this company that does like MLO stats,
Yeah.
and most LOs just close like just a couple of loans. Like it's really
Yeah.
not a lot. And
It's not a lot. And I think that, we were our own worst enemy, the industry in general. I mean, you can make a lot of money and do very little work. So it's tough, right? I mean, if you're somebody that does 2 to 3 transactions a month, I mean, it was possible to have a very comfortable living and spend a lot of time golfing and not a lot of time working. So, I think that that's going to change. And I think that it's good that the industry's thinned out, right? The people that are left are sincerely going to earn every single penny they make. It's definitely changing. So you got to work hard every single day. Before the rates are in the twos and threes, there's not much to sell, Michael. So it's pretty easy. It's going to sell itself.
yeah, since you're in it, like you've been in it for decades now, and you're still actively in it, how are you seeing the sentiment to people who are left, like LOs that are left right now? Do they have a reality check that, hey, I need to work harder?
Yeah, I think everybody. Well, that's an interesting question. I hope so, because I think that that's the reality of the new market. You have to work harder. You got to forge more relationships and more referral partners. I don't think this is a situation where you can just have 5 or 6 agents and live on one deal every other month, and then you're supplementing it with refinances. The refinance market's gone. So I think the reality is, if you've renewed your license in 2025, then you're all in. I mean, you're all in, and you're going to be working your butt off to forge more relationships with referral partners, whether it's real estate agents, you know, uh, financial advisors, divorce attorneys, whatever it takes to survive 25. So, yeah, absolutely.
I totally agree. I totally agree. And in just a couple of minutes that we've been talking, you've pointed out some really amazing insights. And I just want us to take it back to the beginning, to when you just got started in the industry. Like, what made you get started? Back to young Daryle, just taking a
Yeah.
leap into the into the industry. How was it like for you?
Yeah, it was awesome, man. I mean, I was in consumer finance for from 94 to 99. And consumer finance was an awesome experience. It was like just a fire hose of information. I mean, you learned how to manage profit and loss, credit risk, collecting the debt. So you had to be responsible and lend responsibly, and you had to learn how to sell. And I mean, if you know anything about the consumer finance industry, we weren't selling interest rates, at 7, 8, 9%. I mean, the typical rate on a personal loan was, maybe as high as 36%. And I know that sounds like loan sharking, but that was like a real business and a real industry. So, as I learned the finance space, and I was really probably a better collector of the debt than I was a salesperson. I thought, man, if I can collect money, I should be able to sell money, right? Like give people money in exchange for an interest rate, right? So that was just like such an eye-opening experience. So I mean, starting in consumer finance, moving over to the wholesale channel, in being an account executive for a mortgage bank or wholesale lender. That was awesome experience too, right? I got to understand like what it's like to work with a mortgage broker, right, as an account executive. And so I mean, I've seen all facets of the industry. So I'm just passionate about mortgage. I love this space. I think there's tons of room for improvement, and this, right? I mean, in getting to know you, I think, one of the things that you learned through your, education and in doing some work with banks, you learned pretty quickly that, wow, this is like not the most efficient industry in the world, right? And there's opportunity here. So what do you know? Next thing you know, you start an AI company that's super cool in Silicon Valley, and that's something to really be proud of. And I love entrepreneurship, and I think that that's just, I mean, to me, that's everything, being able to have autonomy, think for yourself, and live and by your decisions. And I always say, I'm always going to bet on myself
Yeah.
100 out of 100 times. So,
Yeah, you've gone through every single, or not every single level, but most levels of the mortgage stack. Like you've been an account executive, you've been a collector, you've been a VP. I like to say you didn't skip too many steps. Like some
no,
people come in and then they're straight to C-suite, or come in and they're straight to like something. So you have experience with every single level. And
yeah.
does that shape your perspective compared to, let's say, other C-suite or director level?
Yeah, for sure, right? I mean, I think that working in the independent mortgage banking space, stepping away from it today, I certainly understand the challenges that they had and have and will continue to probably have for the foreseeable future. And but there's also challenges on the other side, on the broker space, right? Which is kind of the space that I kind of self-directed. I exited the mortgage banking space to start my own brokerage. And for me, it was the right decision. I mean, I can see the writing on the wall, right? I mean, these mortgage bankers have to limit staffing, positions like, VPs, things like, you don't need them, to be honest with you. There's so much redundancy and so much expense associated with running a bank. You can see the writing on the wall. So, I made the decision to exit that space and enter into what I felt was like more of an emerging market, which was like the broker space. And it's been slowly gaining market share for a number of years now. And, I think back to, prior to the housing crash in '07, '08, I mean, the brokers had a good chunk of the market, and it's starting to trend back in that direction. I don't advocate for either. I think that they're both fine spaces to work in.
Yeah.
For me personally, I just thought, yeah, you know what? If I'm going to step away and not manage people any longer, then I want to basically row my own boat. So That's why I
Yeah,
decided to start Rebel Rate Mortgage. So for sure.
amazing. Speaking of Rebel Rate Mortgage, what is Rebel Rate Mortgage?
Yeah, so we're just a mortgage broker, very small. I don't think that we're trying to really expand. We're really using the platform to, I think, hopefully be a little bit. Let me back up, I guess, a little bit. I don't think there's a huge differentiator in the mortgage space, period. Right. And some people argue with me on that. I think we all have access to the same products. I think we all have access to, you know, you know, a whole bunch of similarities in banking, brokering. I think one of the things that makes us different is we decided to just be a price leader at the end of the day and just say, hey, you know, I don't think service is a differentiator. I don't think product is a differentiator. So what does that leave us with? It leaves us with price. And ultimately, we just said, we're going to be a low price leader in a market where people are shopping more, right? If you think about Amazon's a great example. You go onto Amazon, people will buy something for $50, check out. They're not necessarily shopping all over Amazon. That pops up, they buy it, click, day later, it's on their doorstep, right? A home's different experience. I mean, this is a large financial decision. People are going to shop that transaction. I think people are shopping more and more. I think the information's out there to the consumer where it's in their face more, like interest rates, other alternatives. So I think we just decided to say, hey, we want to be disruptive and just work for a flat fee per transaction and try to go out and grab more market share. I don't think it makes sense to try to, be a guy that does 2 to 3 loans a month and tries to make a living. This is an opportunity to go out there and expand the business and partner with realtors, but tell a different story. I
Yeah,
mean, every loan officer, is going to call up and say, I got great service, right? Heard that 1,000 times before, right? We execute at a high level. Every agent's going to say, I've heard that 1,000 times before, right? So, pricing is truly our only differentiator that we can actually express and clearly demonstrate to a real estate agent. And I think we do that very, very effectively. And people need more buying power right now. So,
right. That was actually one of the first conversations that we had when you told me about your pricing model at Rebel Rate Mortgage. And it really attracted me because the first couple of interactions that I had in the industry were people trying to maximize how much commission they can make on a transaction. And here
right,
you are saying, well, we're just going to charge you a flat fee and then see how we can scale our business from there. Do
right.
you think that, well, let me frame the question. Don't you think you're leaving a lot of money on the table doing that?
Um, yeah, maybe short term, but long term, no, because the market's going there, right? I mean, you're going to see technology evolve to the point where people are going to work for less. I mean, I don't think AI is going to go out there and replace every facet of the origination process or technology, but I do think it's going to definitely put downward pressure on price. I mean, I think the expectation is, you're going to have a human in the loop helping with the transaction and facilitating the transaction. But ultimately, you're going to be expected to do, like I said before, 3, 4x the number of units to make the same kind of money you were doing, 4 or 5 loans, right? You're going to have to maybe do 15 to 20 transactions to make that same kind of money. And I think that that's just the nature of the business. So I don't feel like I'm leaving money on the table. I feel like I'm building my business, right? I feel like I'm making an investment and I'm trying to get ahead of where the market's going to be. I always say I don't want to try to go where the puck's going to be. I want to be there waiting for the puck to arrive. So I might be early but I don't think I'm wrong. And people might differ with that, but like I said, I'm always going to bet on myself and bet on my instinct. And I think that's where it's headed. And any loan officer that's currently out there in the independent mortgage banking space or the broker space, I promise you, they've revisited comp either from a corporate level, if you're working for a banker, or even you've self-evaluated as a broker and said, am I priced to stay in this market? Am I at the right price point to be competitive.
Yeah.
Because that you're gonna have to continue to just work for less but do more units. It's gonna be a volume play.
Yeah. And I think this is a very important lesson for all of the leaders watching this podcast, which is don't be afraid to take a short-term price hit
Right.
for long-term success. And you're one of the exemplaries of that.
Yeah, I mean, I think that, yeah, I mean, I had a lot of conversations with loan officers throughout my career. And, the toughest one was always like the compensation conversation when things got tough in the space. I always told people, like, my philosophy was like, I'm never going to tell you what you're worth. Like, I'm not going to tell you to reduce your comp, but the market might tell you what you're worth. And if you have to keep asking for price concessions, you need the company to lean in 20, 30, 40, 50 basis points. That's telling you that you can't sell the market rate, right? So the market's telling you you're priced too high, so you might want to reduce your compensation. And those were tough conversations to have, but I let people make their own decision, and empowered them, but they understood at that point in time that the amount of concessions that they could come back and ask me for was going to be limited. And I think that's just being transparent, and being a good leader is being honest with people. And I took a lot of pride in that, always being transparent, upfront. Here's how I see it, and the market will always tell you what you're worth. That's the bottom line.
The market will always tell you what you're worth. That's something I'm going to remember from this conversation.
It really will. Really
Yeah.
will.
I like that you have these short and succinct statements that really have a lasting impact.
Yeah.
The thing I was going to ask was, well, one related to hiring and the other one related to operations. So we've had CEOs on this pod, we've had producing branch managers, and all of them are thinking about, well, how can I make my operation leaner? And here you are being a price leader, which means that you have some sort of like operational magic that you're running.
Yeah.
Like, what would be your advice to producing branch managers and CEOs who want to run a leaner operation?
Yeah, I mean, I think you have to be tech forward. You have to look for every tech advantage you can find. You and I have discussed this at length that, I've talked to, a couple of different, CEOs that I've worked for in the past. And, I think of the last 10 years, they've put a lot of money into automation to the back office, right? Underwriting, things like that. And I think that what they found is all it's done is cost them more money, right? Because it's hard to get rid of that human element, I think, at the end of the day, because at some point that loan has to be sold off in the secondary market. And are you going to trust, a full automated underwriting process to deliver that loan to the secondary market and hope it doesn't get bought back? Or if there's not some defect in the loan that they refuse to purchase it, and then you have to sell it scratch and dent and take a haircut. So there's a lot of risk with investing. I mean, you have to invest to be efficient. So technology should exist both in the back office, but I think what's been missed is front end technology. And I think people have tried. And one of the things that I did was when I made the decision to say I'm going to work for less, I said I have to create a super efficient system. So we created technology, which you're aware of. You demoed it with us, and I think it kind of excited you. App Catcher, and that was like the light bulb moment for me to say, "Gosh, man! I mean, there's a lot of cool tech on the front end of the mortgage space, but all of it leads to more expense, right? I mean, of course, you have to pull a credit report. That's gone up exponentially over the last, 12 to 24 months. I mean, a credit report for a joint borrower is over $100. I mean, and there's a small percentage chance that they might actually qualify because the rates are elevated, right? And then on top of it, you have the open banking platforms. You can do verification of deposits, right? You can order a VOE. All those things cost money. I mean, you could be into a transaction for $200-300 and it may never see the closing table, right? So we built some technology saying like, okay, we're work for less. We also have to figure out a way to produce a loan for less. So the technology, I don't want to get into too many details about it, that we're putting out there, into the universe, hopefully at the end of Q1 here, solves a lot of those problems, right? And then, fortunately, I ran into you, Michael, and I was able to, connect the dots between like what you're doing from a tech standpoint, and together we said, holy cow, you put these two elements together, we would have something pretty doggone special. And I'm really grateful for the opportunity to be able to integrate with Addy, because I think it is a game-changing technology that's going to be extraordinarily disruptive, and in a good way, right? So yeah, you have to have the tech if you're going to be efficient and work for less. And I think we're proving that every single day that we made the right decision. So I keep in mind, haven't originated for a number of years, and I think we're doing better than average, right? I mean, we've closed anywhere from 15 to as many as 21, 22 loans, so in a tough market, which I think is pretty respectable. And we're doing it by being a price leader, right? And also leveraging some of the best technology, I think, that's in the market. It's only going to get better as we start to integrate with Addy and other integrations out there. So we're excited.
Yeah, it's a mutually beneficial system. The better tech you have, you get to run a leaner operation, you get to have more volume, and
That's
then
right.
lets you lead more in price. And you bring up a brilliant point by saying that we've had experiments, I call them experiments, done with some software technologies that were seemingly supposed to reduce costs, but all they do is rack up costs. Like all the backup technology, you got your underwriting systems, you got your compliance systems, even like some servicing systems. And all the back office tech they've done, all they've done is just rack up more costs. And what is really left to experiment with is something that lives at the point of sale, something that lives in the origination side of things. And you've seen that with all of your decades of experience in the industry. That's where you see the puck is going.
100%. That's going to be the biggest pickup, right? It's going to be tech on the front end, and and honestly, I think that we rely in the industry on cycles, right? Like refi booms. And I always use this other great little phrase. I always say you only know the future based on your past experience, unless you're in the mortgage industry. You've probably heard me say it 1,000 times, because we are just absolutely creatures of habit, right? You see it all the time. I mean, you got to remember there's a run from about 2001 to 2022-ish, where the rates were pretty doggone good. There was some short windows of challenges in there, but nothing like we've had, over the last 2.5, 3 years, right? As we head into 25. So, I think companies are starting to figure it out. You don't need big brick and mortar. You don't need all this bricks and stick. If the pandemic taught us anything, you can still drive culture through a Teams meeting, right? It used to drive me crazy as a leader in the industry to walk into a branch and go, "Where's Joey, the guy that needed the corner office with the view today?" Well, we haven't seen him in a couple of weeks. I'm like, "Where's he at?" He must be out selling. I'm going like, okay, well, that's great. I hope he is, but Joey's done one transaction in the last 30 days, right? Like those are the challenges in the mortgage space. And then of course, people staff inappropriately to accommodate people. So I think the industry's figuring it out, and they're going through a reckoning. And I don't think they're going to make those same mistakes going forward. I hope they don't. I hope everybody's a little more fiscally responsible, because, the industry is very socialistic the way it works in terms of expense. So, you could be running a great operation in, Arizona, but you could have, some other guy, halfway across the country just tanking. And ultimately that impacts revenue throughout the organization, and margins get pushed up, right? I think that's the reason why a lot of people kind of are starting to kind of gravitate more towards the broker space, quite honestly, is they want to be able to control their expenses. They want to make the decisions, but they also have to be very prudent about making the right decisions when it comes to the right technology, right?
Yeah.
What am I going to invest in, right? I'm going this alone. I want to row my own boat. What's going to be the right tech stack for me?
Yeah.
So, and hopefully we'll be able to guide some of those people through that, Michael, you and I,
Yeah.
so I'm
Yeah.
excited about that.
Yeah, I hope so. I had a LinkedIn post the other day about the amount of chaos happening. Like we're seeing stuff happening on capital markets. We've seen like stock prices of Fannie and Freddie. We're
Yeah, I
seeing
saw that post.
in DC with regulation. We're seeing stuff happening in Silicon Valley with tech, stuff happening with what you're doing, like the shift to brokerages and the number of LOs in the industry. Like so much is happening. And it seems
Yeah.
like, how do you feel about all of these chaotic events, like I would say that are happening right now? Like, what are your
Yeah,
thoughts?
I mean, I think that everything, like I said, kind of happens in cycles, right? I think the mortgage industry went through their disruption and after the mortgage meltdown, right? The housing crisis of 708, we went through compensation reform. We went through disclosure reform. There was a lot of changes that we went through that were painful. So when I look at today's world, to your point, all the disruption that's happening, I look at what's happening in the real estate industry right now with NAR, right? I mean, and the settlement. I mean, that's a pretty big disruption happening there, right? So I think we've taken our licks in the mortgage industry. I hope we're learning from our past experience and we're not going to make the same mistakes we made in the past. I think that people that are buying homes now qualify. So I don't think we're going to have a market crash.
Yeah,
I don't think we're going to see housing values tank. I think people move today if it's job related. Maybe there's some sort of unexpected life event that requires them to move into a single story or relocate, closer to family. Those are the reasons people are selling. Um, it doesn't make a lot of sense to sell to downsize to only potentially pay more for the mortgage payment, right? And that's a pretty bitter pill to swallow. So I think most people are kind of just hunkering down. So there has been a lot of disruption. There is a lot of events happening, but we can only control what we can control. And I think that the NAR situation is going to be really interesting to follow over the next year or two. It's new,
yeah,
so I don't know that we necessarily have seen the total impact there. And I have some thoughts on that for sure. So
yeah. Do share, do share.
well, I mean, I think I think that I don't think it's going to have much of an impact in the mortgage space, minimal. And I'll maybe circle back to that. But I think when you go on a listing presentation, if you're a real estate agent, you hope everybody kind of toes the line, right? Everybody's selling it the same way, right? And if people aren't familiar with the settlement, it was always just assumed that the seller would pay the buyer's commission, right? So that was a whole prompted this lawsuit. And if you put it in MLS and you listed the property and you had a 1% co-broke on there, the property wouldn't get any traffic because agents would, just, unintentionally not show their client maybe that home, right? That was in their best interest. And it was just assumed that the seller was going to pay their commission. So now that's changed. Buyer's agents can't even show somebody a home until the customer signed a buyer broker agreement. That's a pretty big shift, right? So imagine having to sit down and talk to a customer and say, hey, I'm happy you found the house on Zillow and you contacted me, or you found the house here or there, everywhere. But before I can show it to you, you have to sign this buyer broker agreement that stipulates you're going to pay me whatever, 2.5%, 3%, and then I can show you some homes. They've never had to have that conversation, right? The conversation was always, don't worry about it. The seller pays my side. It's a given. Don't sweat it, right? In fact, it's in MLS. It's right here. It says right here, they're going to pay me 2.5%. You don't have to worry about it. And you didn't have to have the agreement signed. You just show people houses.
Mhm.
So if the listing agents and everybody bands together in the real estate community and sells it the right way, I don't think there's going to be much disruption. But I think you could have, that industry start to fracture a little bit. I mean, what's the obligation of the listing agent on the listing presentation? You're trying to win the listing to get the house sold, right? I mean, I might just go in there and tell them like, yeah, end of the day, for me to list your house, it's 2.5%. I'm not going to talk about, the other 2.5% that's going to come in with the offer, not to mention the potential concessions. I mean, if agents start going down that route, it is going to cause some disruption. So hopefully they all stick together as a community and they get through it together. And I think every listing agent, there's no such thing as just a listing agent anymore. I think that they do both sides, so they do understand. But, when you start looking at, a 5% commission to sell a house on top of every single buyer now needing, some sort of concessions, or not every single, a large chunk of buyers needing concessions, be it 1, 2, 3, or 4% of the sales price, it could cost that seller anywhere from maybe as little as 5 to as much as 8, 9% or more in some cases. So I just think the commission thing is going to get looked at heavily when you're a seller, because they're more acutely aware of it, right? Depending on how the listing agent presents it. And maybe LOs have to revisit their compensation and say, do I need to reduce my comp so I can lean in and give a lender credit? That could potentially be the impact, but that could also win you business by being a good partner to your real estate partner and your referral sources, right? So, I think that's where I see the impact, maybe a little bit in the mortgage space, but pretty unlikely. Most likely it'll be minimal change. I think consumer behavior could change though.
Yes. Yeah. Amazing. So the reason why people listen to the pod is for these expert breakdowns like these.
Yeah.
So you just told me exactly some potential things that could happen on the listing side. You've told me some things that could happen on the buyer's side, and like the agent side and the buyer broker side, and even on the mortgage side and potentially on the consumer side. So it's all of these moving pieces, and it's just one settlement. So just one settlement affecting all of these moving pieces.
Yeah.
I think there could be more. There's like a couple more.
I've heard some other things happening. I don't know that I can really speak to them with a great level of confidence because it's so new, but I'm hearing there's different lawsuits popping up now that are class action that could potentially impact the real estate industry further. But, historically, you could see a shift in consumer behavior, which could potentially benefit the mortgage industry. Historically, the customers would go to a real estate agent and say, I want to buy a house, right? You got the inventory, you've got the asset I want to buy. That seems like a logical place to start, right? But now all of a sudden, that conversation is, well, before I can start to show you those assets, you need to sign this agreement for 2.5%, saying, I'm going to get paid that amount, right? Like my goal is to always get the seller to pay it, but that's the agreement. It's legally binding. So maybe the consumer at that point steps away and says, hey, wait a minute, I need to go get pre-qualified first before I commit myself to paying this agent 2.5%, right? There could be a shift in that direction. I don't think anybody in the mortgage space is going to necessarily market that because I don't think that would be good for business, but it could just be a natural shift that happens in the marketplace. Probably low probability, but it just depends on how this thing all shakes out at the end of the day. It's just too new to tell. And if everybody plays nice in the sandbox together, right? So
we're very early in a multi-decade super cycle.
Yeah.
Yeah. Very, very
Yeah,
early.
exactly. Yeah, it's been a wild ride for sure the last few years. That's for sure.
Yeah. We didn't get to talk about AI a lot, but I want to set the tone for the rest of the episodes coming this season. This is the new year. Your episode would be the first to go out. And as leaders, producing managers, and CEOs are thinking about, well, what should I focus on this year? I want to take a different spin on it and not ask you like what they should focus on, but what do you think will happen? Like some predictions by the end of this year. Like if you would make 2 to 3 predictions.
Ooh, man. Ooh. That's a tough one.
Yeah.
Yeah, I mean, I think it's going to be more of the same. I don't think volume's going to see a massive increase in pickup. I think rates are going to remain relatively the same. Um, I think there is going to be a lot of people exploring, technology that's going to make the front end more efficient. Um, I think you're going to see flashes of opportunity in the mortgage space. Flashes of opportunities to maybe have a little bit of a refi run. Maybe get a month or two where purchases tick up because the rates dropped. Um, I think that, I hope, mortgage leaders and, LOs are following thought leaders surrounding AI, because I do firmly believe that it is going to be, disruptive, but I don't think it's ever going to necessarily replace the entire sales cycle, like we talked about, of the loan. But you have to be in the know because it is moving like a freight train. And as you know, I read a lot about it. I get the benefit of being able to talk to you and pick up the phone and go, "Hey, Michael, I just saw this. What do you think of this technology?" And you're like, it's like fool's gold or whatever. It's great or whatever. You're just in the know, and like your credentials are so impressive. I mean, I think that's almost a better question for you on the tech side of things. Where do you see it going? Because I think you're like an absolute thought leader in AI. And I mean, thank God we had that cup of coffee, almost a year ago, right? I mean, I feel very fortunate. And I think where we're headed together on some of our ventures here is going to be exciting. And I think it's going to be very impactful for the entire space.
Yeah, for sure. I'm gonna agree with all of what you've said. And so I don't think much is gonna change. By the time it changes, like there's this sort of like flock mentality where the time it changes, there's gonna be a huge influx of people that drive towards the change. Right now, it's only a couple of people. It's gonna take a couple of months, 24 months, and then everyone's gonna have the wake up call and
Yeah.
start adopting all these technologies that we're talking about here. Like rates are not going to change much, that we already know. So
Yeah.
yeah, I think it's an exciting time. I'm really happy to have friends like you in the industry.
Yes. Agreed.
Friends with a lot of experience that I can call up anytime and tell me exactly what's happening. I have the technology experience, but I don't have the decades and decades of market experience that you bring to the table. And I'm actually very excited to have people like you in my network.
Well, that means a lot coming from you, Michael, because I hold you in the highest regard. I mean, I think you're an absolute dynamo, laser focused, driven. I mean, you'll sleep in an airport if that's what it takes to get a sale done, right? Or move the needle for your company. And that's the suffering and the pain that a lot of people are unwilling to go through. But those are the scars that are going to make you great one day, and you're gonna leave a huge impact on it. And I'm thankful every single day I get to partner up with a guy like you, and along with some of the other folks involved in our venture. And I think we just have a really dynamic team of people all rowing in the same direction, looking to really bring value to the industry and make the experience better for the loan officer and the consumer.
Amazing. Well, Daryle, how can our listeners find you?
Yeah, I mean, the best way to find me is on LinkedIn. I mean, just Daryle Messina at LinkedIn, I mean, so just locate me there. I spell it Daryle. So there's not a lot of Daryls out there like that, certainly. But connect with me on LinkedIn. I love talking industry shop. Happy to talk to anybody about it at any time, and just connect with me. Love to. I respond pretty quickly to most messages as well. That's how we connected, Michael. So it's a great way to connect. So that's where I put a majority of my emphasis and focus. So
I'll put your LinkedIn information in the description on YouTube. So check it out. Folks, this has been another very insightful episode of the Loan Officer's Playbook Podcast. I hope you got your notebooks out because there were lots and lots of golden nuggets in this episode, and I really hope it helps you enhance your business. So until next time, thank you so much. See ya. Bye-bye.
Bye.